Welcome to our next strategy. Writing put strategy is executed by writing or selling put options without underlying stocks. If the stock price rises or remains steady, we can make profit, but the potential loss can be substantial if stock price falls sharply. Writing put strategy is one of the riskiest option strategies and should be adopted only when we have a knowledge of technical analysis. After analyzing the stocks chart carefully and applying a stop loss, we can surely make money in this strategy. Maximum gain is limited to the premium received because we will be paid in the form of premium received for selling the puts in return for accepting the obligation to buy underlying shares if assigned. And maximum loss can be unlimited as the stock falls. The strategy can be used when stock is in an established uptrend and at the end of its retracement phase, or when we get a double bottom pattern in an uptrend, or when last stop of the downtrend is breached upside and also we are getting a positive divergence. Now we will understand the strategy with an example. Suppose stock A is trading at $200 and you decide to write $200 put option at price $2. The lot size is 100, so you receive $200 for writing the put option. In situation first, on the expiration date, if the stock trades at or above $200, then the put expires worthless and you keep the full premium of $200. This is the maximum profit. In second situation, if the stock price drops marginally below $200, say $199, you can still realize a profit since the striking price of $200 is higher than the current price. The put is assigned and you buy 100 shares of that company from the put holder and sell it at $199 per share, resulting a loss of 1 into 100 equal to $100. But you had received $200 for writing the put earlier. Your profit for the trade is $100. In third situation, if on expiry the stock price drops sharply, say to $195, the put is assigned and you buy 100 shares from the put holder and sell it at $195 in the market, resulting a loss of $500. As you had received $200 for writing the put earlier, so your net loss would be 500 minus 200 equal to $300. But using chart analysis, we can apply a stop loss and exit the trade if the stock price falls down that level. Now we will analyze the chart to know our put writing option position. This is the chart of Intel Corporation and this is the daily chart. First of all, we will draw a trend line. We just take two initial points and join them and extend the trend line. This is our trend line. Now whenever stock rises again after touching the trend line or after crossing down the trend line, we can write a put option. We could write a put option here, then here. Again we could write a put option here. This is the point because this time prices falls down to the trend line and then they rises again in upward direction above the trend line. So this was the point where we could write a put option. But here a strict stop loss must be triggered. Suppose we are writing a put option at $37. In this case, our stop loss would be at $34. As this is an uptrend, after crossing above the trend line, prices will move in upward direction. But if they again fall down to the trend line, we will exit from the trade as they fall down from $34 level. Now see, this is also a 100% retracement level. This is the same level. If we draw a horizontal line here, this is the horizontal line. So you can see this retracement is 100% level. So we can write a put option here at the stop loss slightly below it $1 or $2. We can write a put option here. We can also write a put option at the end of the downtrend. This is the downtrend and when last stop, this is the last stop, when the last stop of the downtrend is breached in upward direction. Now we can see this is the last top level and this is breached in upward direction. Prices are crossing above this level and also we are getting a positive divergence here. So if we get positive divergence and our last top of the downtrend is breached in upside direction, then we can write a put option here because this is the starting of the uptrend. In this case, our stop loss will be the last bottom of the downtrend. This is the last bottom, so our stop loss will be at this level. The big advantage of writing put option is that it is a versatile option strategy which can be transformed into other option strategies in order to accommodate changing market outlooks prior to expiration. And the big disadvantage of this strategy is we can lose a lot of money if the underlying stock falls drastically. But with the help of technical analysis, by analyzing the chart at different points, we can execute the strategy and surely make good profit. Thanks for watching the lecture.